Well, good afternoon, everyone. Thank you for joining. I'm excited because I think there's been a lot going on. I don't think we'll get to cover everything today, but I'm hoping to get a lot of interaction because it's a very uncertain time right now, and having different views would be very helpful. So please chime in whenever you have a strong opinion or are interested in contributing to the subject. I'll start with the results of the poll because I find this an interesting question. So do you think the S&P 500 makes new all-time highs within the next 12 months? So 61% responded no, and 39% responded yes. And now it's 63-38. We got another response. So that's a little bit worrisome because I think it probably won't. But the fact that most of us think it won't usually means that it will. So it's the reverse psychology. It's like until everyone is bullish, it won't go down, and until everyone is bearish, it won't go up. But it looks like more people are bearish than bullish at this point. So just if we're looking at what's coming up, tomorrow is a big date. Does anyone know why tomorrow is a big date? Anybody? Virginia.
I know my name is Stafford, but
Stafford, you're Virginia on this. Sorry.
Yeah. Sorry. Yeah, it's well, Jerome Powell speaks, and he's going to talk about monetary policy and whether he's going to how aggressively he's going to raise interest rates, and about inflation and how fast he's going to unwind the balance sheet.
Exactly, the J-hole meeting, as it's commonly called. Mm-hmm. So that's taking this all with a caveat because tomorrow everything could change, but I think it's good to try to get an assessment of where we're at right now before J-hole. So let's start with the first slide. So the final tally on that poll will be 63 versus 37. 63% no new all-time high, and 37% a new all-time high within the next 12 months. There you go. In any case, so this is, if you guys, so for the LA, I don't know if everyone's from LA, and I'm guessing there's a lot of people that are that I haven't seen in person since this group has evolved a little bit, but we used to do meetings at Screwball. You'd be familiar with this graph because we've looked at it a number of times. So this is basically, and I'll describe the graph first just to make sure everyone's on board. So that gray line is the 10-year minus 2-year treasury. So it's the 10-year yield, treasury yield minus the 2-year treasury yield. That's a lot of people talk about when they talk about the yield curve and the yield curve inversion. Then the other one is the 10-year, the black one is the 10-year minus the 3-month treasury bill. So same sort of idea, just taking the 3-month instead of the 2-year. And then the purple one is the Chicago Fed Financial Conditions Index. And then the red line is basically just the equity market. In this case, it's the Wilshire 5000. You could substitute by the S&P. It would be more or less the same thing, but it's basically just the equity market on a log scale. So the reason we look at this is just as a measure of where we are sort of in the economic cycle, because typically when the yield curve inverts, and that's generally speaking the more palpable ones, the 10-year minus the 3-month, you usually get a recession and therefore an equity sell-off shortly afterwards. And the process is, as banks lend, they lend on the longer term, so on the 10-year, and they borrow on the shorter term, and they roll that exposure to make a spread on the long term versus the short term. When that yield curve inverts, they no longer can make a spread, so they no longer are able to lend. Is someone? I see that Phil says, can you not see the chart, Phil? Can everyone see the chart? If someone can't see the chart, please shout out. Okay, perfect. So what we're seeing is that here the 10-year minus the 2-year has inverted, but the 10-year minus the 3-month hasn't yet inverted. And if you look historically, that 10-year minus 3-month, whether it's over here, over here, over here, over here, over here, over here, even before the pandemic, it's got a pretty good track record of inverting before a recession. Now, people also look at the 10-year minus the 2-year as well. I think so. The reason between the 10-year and the 2-year versus the 10-year and the 3-month, I don't think there's a big difference, to be honest. The 10-year minus the 3-month is the one that the Fed is going to use, generally speaking, to look at, because they wrote a paper a while ago on it, and saying, and I know Harvey wrote a paper on that too. They wrote a paper saying that was the main one that signified a recession. They also mentioned within that the 10-year minus the 3-month on the Fed paper had to invert for, I think it was 90 days is the way they put it in that paper. So and it makes sense to me. It makes more sense that if there's no short-term borrowing possible, so that means if the 2-year and the 3-month are above the 10-year, the banks can't lend. But as long as there's some sort of part of the curve on the shorter term where the banks can borrow to then lend long-term, they can still make that spread, and they can still make money, and therefore they can still lend on a profitable basis. So why is the 2-year inverted and the 3-month, the 10-year minus 3-month not inverted? Well, it's fairly simple, because right now the Fed is in a rate hiking cycle. So future expectations are that the Fed will continue hiking, and therefore that 3-month, which is more to the short-term rate, that doesn't factor in sort of the future rate hikes that'll happen this year, isn't there, and therefore the 10-year minus the 2-year has already inverted, because it's factoring in sort of the future rate hikes within sort of the next 6 months to 2 years. So that's the simple explanation for the difference right now. And so if we look at that so I'll go with that one first. So if we look at it here, this is basically the target rate probabilities for the September meeting. So that's in a couple of weeks. The current target rate is 225 to 250, and there's about a 60% chance for the Fed to hike by 75 basis points. So that would basically bring, because right now the 10-year is roughly around that level, it's around 3%. So that would bring the 10-year, if they were to hike 75 basis points, to inversion. So the 10-year minus 3-month would invert at that point. So we're not far off from it at this point. I'll pause there for a little bit. The one thing I did want to show you is, and this is not a very long track record history, but this is sort of the same graph as before. This is in orange, the 10-year minus 3-month, and then on the candle chart is the S&P 500, the index. What you do see is if you were to look at it, is that typically, and so that purple line is when the 10-year minus the 3-month goes below zero. That's the zero line. Even though it says 381, if you look at it to the right chart, to the right y-axis, the second right y-axis, it shows you 0%. That aligns with that purple line. So if you see during 2000, that 10-year minus 3-month inverted exactly or very close to the all-time highs before the sell-off. And if you look at it on the 2008 crash, well, it inverted quite a long time before. So it's hard to use the 10-year minus 3-month to really pinpoint when you should be getting out. But what you should probably be doing at this point, if you haven't, is probably at least easing up on risk, because it's not a good sign that we're close to inversion. Any sort of thoughts, questions on that before I keep going? Moving on to the next chart here, and so this is basically, so we talked about the market probability of hiking 75 basis points. So basically, that's what this was currently right there. It's evolved since I put these graphs, so just bear with me. It is currently at sort of around 70%. So if you recall previously, there was an employment report that was fairly bullish, showing that employment is quite strong. So people thought that the Fed would be able to hike. And the CPI report came out, and for some reason, going from 9.1% to 8.5% really made people think that the Fed wasn't going to hike anymore because inflation was coming off. So that probability went back down from sort of that 80% level to around 50% level. And then progressively, as time has gone by, you've had a lot of Fed speakers come out and talk and try to reverse sort of that sort of sell-off in the probability, or the sort of the dovishness that people implied by the inflation report. And you progressively see them talk the market back up to a 75 basis point hike, sort of that September meeting. And I don't know if you remember when the FOMC came out, a lot of people thought that they were originally very dovish, but then progressively some Fed speakers came out and said, no, actually, we think we need to be hiking, and we need to continue hiking because employment's not a problem, but inflation is still a problem. Speaking of which, I think I put in. Yeah, I was gonna touch upon that since I'm talking about it now. I'll come back to the other slides, but this is the inflation report for July. So I think it's a little bit interesting, and it's important to go and dig into it a little bit. So if you remember this, so this all items is what people call headline CPI, and that headline CPI here on an unadjusted 12 months, so basically the year on year of July 2022 was 8.5%. The previous number was 9.1. So people, when they saw 9.1 go to 8.5, thought that was basically inflation peaking and things coming off, and therefore the Fed should be less aggressive. The thing that people forgot was that this all items less food and energy here is basically the core CPI. That's also the name for core CPI. And that is at 5.9%. And the previous month, it was also at 5.9%. And that's actually the inflation target that the Fed has is on core CPI, not headline CPI. So the core CPI essentially stayed steady at 5.9% from June to July, even though the headline CPI has come off. And now if you try to dig in a little bit on the month to see what came off, what you realize is if you look into these details that you look at the energy, so energy is off about 4.6%, and then energy commodities are off, gasoline's off, fuel, oil is off, and then you've got utilities, gas services are off. So those are the big items that are off. All those items are energy, so basically crude oil related. So it's really basically just crude oil coming off that has driven the headline CPI down. Most of the categories that you'd think of otherwise haven't really come off. And really, the one caveat to that would be sort of that used cars and trucks that is slightly off, but that's still a minor effect, I would say, to a certain extent. So if you look at the numbers, it doesn't seem like there's been that. It basically seems like energy is bouncing around and causing CPI to jump up and down. But that generally speaking, the inflationary pressures haven't subsided too much, and that the path to get back down to sort of a 2% range on core CPI from 5.9% could take quite a while. So this is, again, if you guys have been seeing this at Screwball, this is the same thing I use, and I use what they call the CPA tax. That's the FRED moniker, FRED being the Federal Reserve Economic Database. CPA tax is the corporate profits adjusted after tax. And what I do is I basically do a typical type of thing that's the Schiller P, where you basically take the real earnings over the past 15 years and you look at what it implies for as a ratio, so a P ratio to the future 10-year returns. So what this implies, and again, this is on a nominal basis because the R squared is much better on a nominal than on real. It implies that the R squared is about 77%, so fairly good. It implies that the nominal return over the next 10 years, given the current sell-off and given the current sort of trailing 15-year PE, would be 8.5%. Now, given that CPI currently is at 8.5, and I don't know what's going to be going forward, but that let's say it's even sort of 3%, that puts you in like a 5.5% real return. Not that anyone really that it really matters if you've got nominal or real, because the point of investing is to get past, is sort of to compensate for inflation anyway. So I feel like personally, I know a lot of people look at a lot of sort of institutions look at it as a real return. I think nominal is just a little bit more palpable because you've got to do something with your money, and if it's sitting in cash, it's getting zero nominal, and if it's basically invested, it gets still a nominal return at the end of the day. So the lowest common denominator is cash, which gives you zero nominal. Or at best, maybe call it the 3-month rate if you're in short money markets or short-term treasuries. So if I look at that, so this is the regression, and this starts in 1947 and goes till today. And then this is basically what historically it looks like. So the blue line is the actual realized 10-year future returns from that point. So if I were to take in April of a little bit after, call it July of 1999, if you were to invest there in the S&P 500, your returns would have been negative over the next 10 years. And then this is basically what the rejection would have predicted based on the regression would have predicted based on the previous graph here. That's the regression, and that's 77% R squared. Now, what it's telling us right now, and is that if you look historically, in a nominal basis, you're roughly in the middle of the range. 5%, if you think about it, is sort of at the bottom of the range. And then 15% projected is great because that's sort of at the top of the range. This is not a very good timing tool. It just sort of gives you a sense of what you can expect in terms of equity returns over the next 10 years. And then this red line, of course, is sort of the S&P 500 since 1947. So one of the things to note is that one of the ways of looking at the 10-year and thinking about inflation and the issue we currently have is that, generally speaking, people think of the 10-year and nominal GDP as sort of being two things that are quite linked, because the 10-year factors in sort of future growth plus some sort of inflation, and so that's very similar to what nominal GDP would be. So the blue line here is nominal GDP minus the 10-year Treasury, and sort of the inflationary pressures. So the more this blue line goes positive, the more you think of there being inflationary pressures, and the more the blue line goes negative, the more sort of deflationary pressures you're going to be having. So as you can see, the last time we got to this level was probably something circa 1974-ish. I can't read the bottom of the graph. What does it say there? Yes, roughly call it, 1974-ish was the last time we had such strong inflationary pressures as measured by that difference between the nominal GDP and the 10-year Treasury yield. Now, I also plotted here the 3-month Treasury bill, and this is the difference in percentage points of the 3-month Treasury 1 year ago. So if it was 50 basis points a year ago and it's 3 basis points today, that's an increase in, 3% today, that's an increase in 250 basis points, or 2.5%. So that's what's plotted. It's the differential. It's not the actual value, but the differential from 1 year ago. And it's sort of a measure of how the interest rates are tightening financial conditions on the short end of the yield curve. And so what you see is previously these rates usually got a little bit ahead of these bump ups in nominal GDP, or at least in sync. Here, there's been a big delay in trying to compensate for that takeoff, sort of that nominal GDP versus the 10-year yield. So there's sort of been that spiral where the nominal GDP and therefore inflation is starting to take off quite a bit. Now, I don't think we're anywhere near sort of inflationary spiral, and I think we'll probably be able to avoid it. But I also think that's why the Fed is very focused on trying to bring inflation back into line with its targets, which is basically 2% core for a 5.9% core currently. And I'll pause there. Any questions? Any comments? Stafford, whereabouts do you come from? Virginia?
No. Dana Point.
Dana Point. Oh, okay.
Virginia is my mom's name. It's her computer.
Oh, okay.
Yeah. Go ahead.
Given when you're probably, I don't know if you followed, probably one of the ones who's followed maybe fewer of these webinars. Any questions or thoughts or comments on it? Any new perspectives?
No, I think it's great. I mean, it's a little scary. I think we got to lower our expectations. I don't think we'll have returns like we've had the last 10 years, but that's okay too. So, but yeah, it's interesting and, makes you think a lot.
It's a little scary time.
Yeah. You just try to stay calm.
Exactly. Not overcorrect.
No.
So the next graph is sort of another measure, and I should have put this in the links, and I'll try to remember next time. But there's I think I mentioned it. Maybe there was an article or a blog from Scott Minerd. If people aren't familiar with Scott Minerd, that's the CIO of Guggenheim Partners.
Yeah.
He wrote something about skip Volcker and go back to 1946 in terms of the way to look at things, and I think that's quite interesting. And one of the things he mentions is that the way that 1946 they brought inflation back down was by ramping in credit availability. Mm-hmm. Right now, that does not seem like credit availability is sort of, and that's what's graphed here is bank credit, or basically the availability of credit to banks. It's not a very broad index, so it's not super reliable, but it doesn't show that we're doing anything to rein in credit in terms to reduce inflation. So the credit is still sort of on the same sort of year-over-year expansion around 10%, which is quite high if you look at it, sort of on the upper end of the range spectrum of credit expansion. So that again contributes to inflationary pressures, more liquidity in the system.
Now, I was going to ask you, do you think that with the forgiveness of the student loans, do you think that will cause inflation to spike too as well?
Well, it's not going to reduce inflation. I mean, it's just adding money to retail, which is. Sorry, go ahead.
Oh, and then I know there is some. I know the green's good too, but I know that there's some thought also. I've been reading in Barron's that some of the green, like new like windmills and such, is going to cause inflation to spike as well. What are your thoughts on that?
So that one, and my background's in energy originally, is a little bit of a different one. I think that's going to increase the cost of energy in general because a lot of those things are subsidized.
Mm-hmm.
So it essentially means that you're not necessarily favoring the most productive forms of energy, and we've sort of reduced fossil fuel production in the United States. So we're having to import it more, which is part of the reason with the Russia problem that everything's spiking. And the current administration has basically canceled a lot of leases that could have been otherwise exercised. So that's not helping on that front. Providing maybe cheap energy on renewables might alleviate to a certain extent that situation. I'm just not sure how much it'll alleviate. It's very hard to determine. It's very insidious because one of the things, if you look at a lot of these programs, historically have not been provided by subsidies directly, but provided by tax credits. Okay. And so those tax credits don't necessarily show up in the price of energy because they're paid by the overall taxpayer and by at the end ex post, but they're not present in that price that you're paying, right? Okay. So to a certain extent, maybe providing tax credits doesn't show up in the price of energy and maybe makes it cheaper because people are building facilities. But on the flip side, we're not favoring sort of filling the original problem, which is we don't have enough fossil fuels. Because the reason Europe's power prices are spiking, and we're talking really spiking. France, 1 year forward power price reached 900 euros per megawatt hour. In California, we're generally around $35 per megawatt hour. And right now we're roughly at parity between the dollar and the euro. Mm-hmm. So we're talking like 20 times more expensive plus in Europe. It's due to the fact that they didn't favor the development of the fossil fuel production lines beyond Russia. So they are now actually burning more coal than they ever did before because it's cheaper currently than gas. Mm-hmm. And ironically, they could be probably burning gas oil because that would be cheaper. Right now, it would be cheaper to burn oil than it would be to burn gas to a certain extent. So there's inherent problems in trying to favor something that's not necessarily by market dynamics because the equilibrium that you're going to find is not necessarily optimal.
Thank you.
But Europe, I mean, if you, my personal opinion, again, this is only my personal thought, and again, not to be construed as an investment advice. I don't see how Europe doesn't get itself slaughtered over the next winter, given what's going on. I mean, its industrial base is going to be just diminished. I don't see how a metal like ArcelorMittal can even produce any more steel given the cost of energy over there. Like anything that's an energy intensive industry is just going to be dead. There's just no. I don't see how they get around it. I'm not very bullish Europe, as you probably have surmised. So this is another thing that I sort of want to show you guys, and I find quite interesting. So here you got CPI and you've got the Fed funds rate. So CPI is the blue line, and that's the headline CPI. So the number you see on all the way to the right, that's at 8.5%. That came down from 9.1%. So people got really, really excited about that little move that you can barely see on the graph, and thinking the Fed, sort of was mission accomplished. By the way, that happened earlier in the year and about a year ago as well. So not that huge a deal. And then the other things you have on the graph are the five-year forward. So that's basically the inflation expectation as determined by the market that starts in 5 years and runs 5 years. So for 5 to 10 years out, what does the market think the inflation will be? And it's measured by the TIPS, basically Treasury inflation protected securities. So there's bonds that have inflation hedges embedded in them that trade, and this is how they deduct what that inflation rate is supposed to be. And people look at this because the 5 year, no one has a clue what it's going to be. So it's sort of the expectation of what the general market thinks inflation will be over the long term. And so if you look at it, generally speaking, the inflation expectation over the long term hasn't really changed. It's roughly around 2.5%. And it really hasn't budged much, surprisingly. And so that's one of the things that's a little bit surprising is that market expectations are still fairly anchored in terms of inflation. So that's why there's no running away inflation right now. but the CPI is really spiked, like versus nothing else you've seen historically. And if you look at that green curve, which is the Fed reacting to CPI, and you look especially sort of the 1950s through 1980s, the Fed always was a little bit ahead of that CPI spike. If you look at it, that green line goes up probably slightly before the blue line goes up. So they were sort of always ahead of the curve. Here, they seem to be really, really, really behind the curve right now on the CPI, on combating inflation by raising interest rates. If you look at that differential right now between that green line and that blue line, that's probably one of the biggest it's been. So they're a little bit late to the party. The market still thinks that they can manage it. My only worry, and this sort of graph points to this, is that the rate hike expectations right now are still, even with another 75 basis points at the next FOMC, are probably still too de minimis. I think the Fed was going to have to go even more to be able to combat inflation at this point, because it seems like they're really behind the curve. So the one caveat is that 1946 came off pretty quickly using credit conditions. The problem is I've been trying to read up on 1946, but there's not much very good information on it. If any of you do have any good sources on the sort of the 1946 recession, sort of the post World War II recession, and would like to share with the group, that would be great. I'm really trying to read up on that and see if there's anything that I missed, because that one is one of the situations where CPI actually came down back pretty fast after an initial spike. So we talked about that. So this is another thing that shows that sort of CPI is getting pretty, that inflation is getting more and more embedded. And the reason I chose this is because it's very similar to other measures. Sorry, someone had a question?
Not really.
You don't?
I'm going to be leaving.
Della, did you want to say something?
Sort of an overall way, but it doesn't really apply to what I'm doing. What about you?
I'm just hearing
I'll keep going.
reference.
Let me just mute Della. There we go. So here's a graph that's it's basically hourly earnings. So it's how much someone makes during an hour in the manufacturing sector. And the reason I just picked the manufacturing sector is not because that's the one I really want to look at, but it's because it's got the longest time series, and it's very much correlated to most other sectors anyways. So it's just very representative of hourly earnings across the U.S. And it's one of the longest data series, as you can see. So you saw that in the 1970s, you got this inflation wage spiral, and that's what a lot of people talk about as basically hourly earnings increased from 2.5% year on year to something around 10%. Right now we're at 5%, which is higher than anything since 1980, basically. So we were caught in this sort of low wage increase for a long time. And generally speaking, the reason people look at that is that when wage increases start ramping quite high, and usually 5% is sort of where people start saying you get a little bit out of whack in terms of your plan, is as businesses have a hard time running behind it because they have a hard time planning, they have a hard time figuring out what their supply chain is going to be. And so that wage inflation starts becoming problematic for business planning, and therefore puts a drag on earnings, because it makes it a lot harder for companies to figure out what their actual cost is. And generally speaking, 5% is what, at least from what I've noticed, is when people start thinking that it's a little bit too high.
I have a question, Jesse.
Sure.
Do you think wage inflation will be sticky? Do you think it's a permanent thing? We'll see, such a big jump in wages?
So I think that's what the Fed is trying to combat right now. It really depends on what the Fed does. If they hike enough to get unemployment to go up, the wage is probably going to go down. Okay. I think part of what they're looking at is this wage inflation. That's in terms of most economists, they worry about the wage inflation spiral, and that 5% number is usually a number that raises eyebrows.
Now my second question: do you think, how big of a recession, in your opinion, do you think the Fed is willing to have to get inflation down?
So that's a very good question that I have no clue how to answer, to be honest.
I don't think they want to. In another 08. That was terrifying.
It was, but so they're going to be between a rock and a hard place if you think about it. They're going to have, right now they have too much inflation. They're going to have to hike, and they're going to have employment that starts going up. Mm-hmm. So they're going to have inflation coming down. But at what point is inflation coming down enough and unemployment going up too fast? And my sense is they might be in a yo-yo spiral where as inflation comes down, as the unemployment goes up and inflation comes down, it's enough. But then unemployment goes up too high, and they have to ease again. But then inflation starts going up, and they have to hike again, and they're going to. they might be in a scenario where they're constantly in an unstable equilibrium and they have a hard time trying to plan what's going on.
So Fed could have painted themselves in a box then.
Well, right now they're in a very tough spot because they got a dual mandate. Up until now, they were always focused on unemployment and getting unemployment low, and they wanted to go. I don't know why they did, but they wanted to get unemployment back to pre-COVID levels, which was basically probably some of the lowest unemployment in the history of the United States at 3.5%. And now they've finally seen that inflation's gone way, way out of hand, and so they're very focused on inflation, which is the other part of their mandate.
Okay.
And so they're stuck between the two sides of their mandate that are forcing them. One, inflation going high is forcing them to hike, but then if unemployment goes up, that's going to force them to ease. And it's going to be a very dynamic nature on how they address that going forward. I think right now they're very much focused on inflation because employment's not really budging. But once unemployment starts going up, they're gonna have to focus on that again, and it's going to be much more dual again.
Yeah. And now, in your opinion, do you think most of the people have spent their stimulus checks, or do you still think that has a ways to go for with saving rates and?
From what I've read, those stimulus checks have basically been spent. Now, maybe, I mean, I don't know if you consider debt forgiveness, but I don't think the student debt forgiveness is going to happen necessarily. But the student debt forgiveness would be another type of stimulus check because it's basically a wide program that goes into the population. So it's very similar to the stimulus check. The thing is that if I read correctly, it'll only be voted after the midterms into law potentially, and it's likely that after the midterms, Democrats no longer hold the Senate. At which point it's unlikely that it'll pass. So I think that source of inflation might not come to pass.
Okay.
Or is likely not to come to pass.
Okay, thank you.
And so this was another sort of what I was talking about in terms of non-farm payroll. As you can see, typically before a recession, and it's a coincident indicator, it really happens sort of almost with the top or slightly after the top of the market. The change in non-farm payrolls starts trailing off. You saw this ginormous change during COVID, which we'd never seen before for obvious reasons when everything shut down. Then this bounce back, and so right now you still haven't seen sort of that trail off, and the base effects should have probably more or less subsided. There's probably still some people coming potentially back into the labor force because the participation rate is still not the same level it was pre-pandemic, but non-farm payrolls, the change in non-farm payrolls doesn't show any sign right now that's really conducive of saying that we're having unemployment problems. So the focus is really, and that's why when I showed you this graph, that's why the focus is really on hiking. When the unemployment report came out and showed a bullish employment report, well, the hiking expectation of 75 basis points went from like 40% to around 80%, and that's really the reason why. And this is really, I find this graph, and that's why I put it here, very illustrative of what the Fed's dilemma is going to be. Unemployment comes out and it's bullish, they're going to want to hike, and then the CPI eases, well, then people are going to think they're going to ease, and they're going to be caught in this yo-yo. I mean, does it really make sense to be changing from 40% probability to 80% probability twice within a week, essentially? No. It's going to be a very uncertain time. I'll jump over that one for now and come back to it later. This I thought was quite interesting. I found this on the web. This is from Bridgewater, and it shows the global asset performance by environment. The thing I was going to note is not that one's interesting, but the next one's even more interesting. So it shows basically it's looking at periods of stagflation and periods that are not stagflation. So stagflation is not a very common phenomenon, about 18% of the time versus 82% of the time since 1960. But when you are in a stagflationary environment, the returns of assets are very different from the usual environment. And the things that work during the usual environment, as you can see here, these are the returns. That's a Sharpe ratio. So the usual suspects that work well. So call it, here in this case, equities here, real estate, 60-40 portfolio. They don't work well when you go to the stagflationary environment. Actually, they're the worst candidates. And so a lot of people probably are still in the mindset that 60-40 is great, equities are doing fine, and real estate is going to go up forever. Well, the problem is if we get stuck in this stagflation scenario, what the market's darlings are going to become the the most dreadful parts of the returns. So you've got to be very careful right now in the way you're allocating your portfolio in terms of the way you think about your asset allocation. And I think probably no one on this call, would be my guess, has an allocation to commodities or to gold or to inflation-linked bonds. Those things should be part of your sort of your menu these days, because they're the stagflation scenarios become much more likely. Even if it's not certain, and nothing is ever certain, they become a lot more probable. So when probabilities change, the asset allocation should change. So the one thing I would encourage people to take a look at is to consider these type of assets on the menu. So the inflation-linked bonds, gold, and the commodity complex. So if you're thinking of ETFs, the broad commodities, that's COMT, which is the Bloomberg Commodities Index. It's an ETF, so it's easily investable. Gold, you've got GLD, you've got IAU, IAU being the iShares with the lower expense ratio. And then inflation-linked bonds, you've got TIP or SCHP, which are both sort of the inflation-linked bonds, one by Schwab and the other one by BlackRock, or the iShares. So they're easily investable without having to spend your time dealing with futures or cash bonds. And now if you look at this one, which is interesting, so you've got, these are two different types of scenarios. So remember 18% stagflation, that stagflation, you can split it out into two types of stagflation. One where you've got rising interest rates, which is basically the red one, and then one where you've got falling interest rates, which is basically the green one. So if you're in a stagflation scenario, even if you're in sort of this menu, inflation-linked bonds, gold, and broad commodities, and interest rates are rising, it's still not great. It's still pretty bad. You still get negative returns. So cash then needs also to be potentially consideration, but even cash is going to return negatively, right? Because if you're thinking about it on a real terms basis, you're going to lose money. So the question is, what's the least ugly duckling, or the cleanest shirt in your shop? And so you really have to think hard, I think a lot harder than you had to over the past 40 years, about where you're going to allocate your money. Because we're talking about a scenario that happens 10% of the time, which is not very often, but that is a lot more probable now than it ever has been. And I'll stop there to see if there's any questions, because I think those two things are pretty important.
Oh, sir, I'm sorry. How
Sure,
about
go ahead.
How about some type of farming stock? I know you're not supposed to give individual names, but
Right.
in that type of complex, or some type of farming commodity and such during stagflation.
So we're not investment advisors, just to be clear. So I wouldn't worry too much about it. We really don't provide that. That's just basically a nonprofit. The sort of farming stuff, I don't think there's any good things to get exposure to farming, at least in public markets. Maybe if you do it privately. Okay. The commodities complex would provide, because there's corn futures, there's wheat futures. So to a certain extent, if you were invested in a commodities index, you would get some exposure to that. But to the proper farming and real estate aspect of that, sort of the land, which is linked to the crop, but is not 100%. That I think it's tough to get any exposure. I'm not familiar with sort of any vehicles that would enable you to do that. Okay. But if someone is, please post it in the chat. Any other questions? Any other thoughts? Please chime in.
Hi, Daniel, it's Ira.
Hi, how are you doing?
Really, really well, thank you. I was thinking when you brought up 1946 that the difference between then and now is that you had a lot of service men coming home from the war, and so to some extent, a large having a large workforce available for the helps the economy to be able to expand, and so there wouldn't be so much supply side. It would be easier for the supply side to ramp up because there's an available workforce. That's sort of like my thesis. And I'm also looking at the Fed, as I mentioned a while back, that the Fed is considering a low employment to be a sign of a healthy economy. But the way I look at it, and I'm no economist, but here's how I put it together. It seems to me that a perpetually low employment problem that not just the US is having, but the world is having, would increase supply side problems. So look, if you look at deglobalization happening in many
Mhm.
countries, not just ours, and then tightening immigration as a result, because immigration becomes very unpopular. So people, um, you know, they don't like it. They, you know, and so immigration tends to, borders tend not to be, well, anyway, so you have tightening immigration. And then because of the aftermath of COVID, now we've had an enormous number of early retirements, including my own, by the way. And then also you have lowering birth rates, a problem that
Mhm.
China is looking at as a severe long-term problem. We may also be going into that as well. And then you have increased healthcare productivity causing longevity for the old. So to me, it looks like you could have a recession,
Mhm.
and yet unemployment may look like like the economy still prospering if you just look at that parameter. So this sort of, you know, I'm agreeing with your stagflation prognosis in that it seems like the Fed can't address the supply side problem, but that these supply side problems are sort of societal. And if you add to this that there, like let's say there is a tremendous recession in Europe now, and because of the lack of availability of energy, then in a place, in an environment like that, you're more likely to have tempers flaring between countries. And now the possibility of there being other fronts of war. And so, and then that would, so anyway, I don't mean to sound like, what's the name of the guy who is the Dr. Doom, but
The pout
I
pout
don't mean to
fish.
sound like that, but yeah, I mean, I'm definitely watching gold in the commodities because I see unemployment as being a long-term supply side problem. Do you agree?
So I agree with a lot of you said. I wouldn't say necessarily I think stagflation is a certainty. I'd say it's possible. It's highly possible. I also just say, as opposed to the historical rate, which was 18%, they've measured. If you're jumping at any point in time, 18% was roughly what you would expect for a stagflation scenario. Now I think we're talking that's much more likely than that. I don't know if it's 50-50 or if it's 30-70 or 70-30. I just think it's a lot more likely. So assets that help you manage that should be a lot bigger part of your portfolio than they've historically been, because that probability has increased. I think, like you said, the Fed has a blunt instrument in interest rates, which really can only address sort of the demand side of things. It can't address the supply side. And in terms of sort of energy, which is mainly driven by fossil fuels, policy has reduced that supply, generally speaking. And conflict as well has reduced that. I mean, that the Ukraine-Russia conflict has reduced supply of fossil fuels to Europe and to the rest of the planet, because they're mainly being directed towards Russia and towards China internally. So the policies are not very conducive to increasing the supply side. The Fed is hiking, which is, it can only really affect the demand side, not the supply side. So it sort of almost has to create unemployment to reduce demand to alleviate the supply constraints, which is sort of a little bit ironic. It feels problematic. Yes, their tool is not very good for what we're facing.
Right, but if we do have a recession, that still decreases supply availability even more.
No, if we've got a recession, basically people stop consuming, so it brings down demand, and then the supply, generally speaking. I mean, if you've got an oil field, you're going to still be pulling the oil field.
But then won't producers produce less because they see that slackening
If the
demand?
price is still high, they'll still produce. If you remember 2008, I think the spike in crude oil prices was like 147, and that happened around 2007. And there was a short-term supply drop in crude oil. But then it basically went back to sort of $100 a barrel, and the actual cycle on oil is around 2011-ish, 14-ish is when it started really declining. So 2011 is really the peak in oil for that cycle. So oil, if you're thinking about oil, because, and I'm talking about oil because it tends to be the main driver of most energy, oil's cycle is roughly around 30 years, where you basically have 10 years of sideways after a big drop off. The supply gets eaten up by, and no one's building anything new, which is roughly what's happened since 2014. And then you basically, since no one's built anything new, prices go up, and then that signal tells people to start building stuff because it's economical again to build things. And so people start piling in. I think the caveat we have right now is that there's a lot of policy and conflict throughout the world that has cut off the supply, which has made the price spike a lot faster and sooner than we were usually used to.
I see.
I mean, the Ukraine-Russia situation really put a big dent in sort of our ability to, match world demand in crude oil. And by the way, crude oil demand is now, I think, a little north of 100 million barrels per day, which is higher than it was pre-COVID.
Wow. There's another thing that I noticed, and that was when you talked about credit availability from the banks. That's something that I hadn't seen before. That looks really interesting. But when I looked at your chart, or your graph, it looked to me like when it came down, it seemed like the dates that coincided with credit availability diminishing, those seemed to be times when defaults were high. So is that
I mean, this graph, is this the one that I'm showing now? Is that the one you're talking?
Yeah. So what would happen if we had a recession, and would it take a recession maybe to raise default rates so that would force the banks to rein in credit availability in order to help the Fed out in reducing money that, excess liquidity?
So yes, but so so one of the reasons to talk about 1946 is, from what I was reading, and again, I don't have enough information, so I'm not very knowledgeable about it, but in 1946, the Fed had a concerted effort of decreasing that credit availability before there was any sort of slump in supply. So they were decreasing the supply of availability, whereas what usually happens here is that the banks cut themselves off from credit because they're worried of losing money.
Right.
So the Fed, the regulator, actually decreased it, as opposed to the banks, stopping themselves from creating more.
I see. And it has it been like since 1946, the government has never stepped in and forced banks?
That's my understanding. I haven't read of a period where the government stepped in to reduce credit availability. It's usually been market dynamics that have caused those drop-offs in credit.
So it's an anomaly because of a government policy, kind of like when Nixon in 1971 or two decided.
74.
Yeah. So, but what really fascinates me about this graph you're showing is I'm looking at where credit availability diminished. And so we're looking at sometime like in the 70s, and then again in 91, and then again in the 2011.
Basically, during recessions, it just trails off, and that's usually with banks being just a little bit more conservative because the ability for people to pay is not there. And it's also a self-fulfilling cycle. As people can't borrow anymore, when they borrow at higher rates because the lender is more risk averse, so is asking a higher premium. So they're gonna get less of it, so it increases their overall cost, their interest expense, and that sort of trickles down to creating a huge issue. And you can see that in that 2008 drop off, the credit markets really shut down.
Right. So maybe that's what it's going to take is if the Fed can rein in liquidity, but if you're saying the banks may still offer it, the way to force them, it's going to be really, I don't have any high expectations for the government stepping in again. But
right.
So if market dynamics are what cause the banks to have to rein in credit availability, then what we're saying here is we need a recession to cause credit default to get the banks to lower liquidity to help the Fed out before we're going to be able to rein in that source of liquidity.
So again, this is all very, conjectural. So I wouldn't put too much stock on it. What basically 1946 they seem to have done well is to reduce the credit availability, which reduced inflation because people also then stopped this. Basically, the demand side also was reduced, but much more gradually. So it was a dampener. But what the inflation right now, we've got a big demand driven by a lot of the stimulus checks. That'll probably progressively drop off, but it's still it's caused an inflation in wages, and that inflation in wages tends to be seen as a sticky inflation when it's in wages, and so then companies have to pass that inflation into their the price of their products or services. And that tends to get ahead of itself. And the way that you stop that from happening is by then hiking interest rates, killing employment, so increasing unemployment and decreasing the demand, generally speaking, for companies. That's sort of the process. And there's been very few times where inflation's been stemmed without unemployment growth.
Okay. Well, thank you.
Sorry, go ahead.
Oh, I'm sorry. Thank you for answering those questions. I don't, other people might have some.
Sorry, yeah, I saw someone else potentially raise their hand. Yeah, go ahead.
Do you think the Fed, to slow down credit of the banks and availability, do you think they would use like tightening of Dodd-Frank anymore or anything like that to, make it even harder for the banks to lend?
So after the 2008 crisis, and I was at a bank at the time, so I remember these rules, they had the Basel III rules come out, which were basically rules that increased the risk capital that you had to hold against certain securities or assets.
Yeah.
I don't think they're going to change those again. There's probably been some deviations since those rules, since the GFC, but those basically increased the amount of capital that banks needed to hold on their balance sheets, so to make them less risky.
Okay. So you
sorry, go ahead.
So you don't see them trying to tighten those or bring in new legislation to make it even more where the bank has to hold more capital?
Generals fight the last war, generally speaking, is usually what happens. And so at post GFC, the last war was banks were too risky, so they were fighting that war, but they actually probably compounded the problem, because banks at that time would have been beneficial for them to lend, not to be reduced in their lending. And that's why the Fed then had to QE almost a crazy amount. And actually a lot of that capital was finding itself stuck in bank reserves as opposed to getting lent out. So they sort of created their own problem by, even though injecting a bunch of money in the system, it wasn't getting out of the banking system. It was stuck in the banking system after the GFC.
Okay, so it was just kind of staying there in perpetuity over, okay.
They were just being, because the way that works is that you put banking reserves at the Fed, you put bank reserves at the Fed, and that earns an interest rate. And banks became so conservative because the regulator went, apeshit on them, that they basically just kept the reserves there and didn't really want to lend too much.
Okay.
And the regulator should come in probably, but it should come in before rather than after the crisis, right? It's when things when people are getting very risk seeking, that's when you need the regulator to come in, not after the fact that everything's crashed.
Okay.
So this is one of the things I also wanted to talk about, and I think it's an interesting graph, because we've talked about on this graph about where do we see the wage? Where was wage? So wages are going quite high. So the question is, what are the sectors or what equities do well when wages are high or have little effect from increasing wages? So this one I thought was interesting, because if you look at it, the S&P 500 is about 12%. The sectors that don't do very well are industrials, infotech, communication services, and financials. And you've seen, well, valuations were very high on infotech. On top of that, they have a big labor input into their equities. So that sort of explains their sell-off. And what you see at the bottom of the spectrum is that sort of these more conservative ones, and that there are sort of energy, which has a low labor input, healthcare, and then consumer staples. And healthcare, consumer staples are generally viewed as sort of dampeners to your portfolio. They're more like the risk conservative ones with utilities, generally speaking. But as you can see, all these are sort of things that are more likely to have a sort of a better outcome in a potentially recessionary or stagflationary environment. Does that make sense?
Yep.
Okay. So this was sort of a reminder that, getting out early can be good, can be bad, but it can also be quite good. If you think about it, the person who didn't get out at the 2000 .com high, 2000 bubble.com high, had to wait till basically 2007. And by that time, he was already getting pulled into the next recession. So if he really didn't pull out, it took him from 2000, he had 13 years where basically he had no returns on his capital. That's a long time to not have returns on your capital. So thinking about shifting your asset allocation is something you should probably be doing, especially if you think we're at the if you think the probabilities have changed. And then during this bull run, as you can see, there's been very few drawdowns that haven't been recovered. They've been recovered pretty quickly. So we've created an environment where buy the dip is sort of quite inherent. Now, do we think, is there going to be another all-time high before we sort of dip? I don't know. is it a bad time to be modifying your risk allocation if you're at a 60-40? Probably not that bad a time. I mean, if you look at the S&P 500, we've had a decent bounce since the bottom here. I mean, I personally have been reducing my exposure to equities, putting a little bit more commodities and putting some stuff in cash, just because I think there's uncertainty. I really don't see this as, and I'm also just worried about bonds in general, because I think the Fed is probably going to have to hike going forward, or it's going to have it hasn't factored in the full rate hiking cycle that it really needs. So the bonds are going to be risky as well. And as you can see in the stagflationary environment, a 60-40 doesn't really help you. The bonds decrease volatility, but they still sell off, and they're positively correlated with equities in that stagflationary environment. So it doesn't look at all like what we've seen historically if we think that stagflationary probability is higher. So if you look at this just from a technical analysis perspective, and I figured I would finish sort of on more of the more tactical as opposed to strategic type of moves. We sold off, call it roughly, I think about 30% since the top. We've bounced about 20, and now we've sort of caught into this pretty strong on the way back down, in this pretty strong level between 4,100 and 4,200. And you can see that there's a lot of stuff that is traded. So this is a pretty strong resistance level both ways. My guess is that the Fed tomorrow will probably, and again, we'll see what happens, but we'll probably try to reiterate that it's on a path to squash inflation, or at least to be very reactive to inflation, because that's the main thing it needs to point out. Now, whether that's more than the market expects or not is very hard to determine. And if you look on a much longer term basis, if you were to have a recession, and this comes back to my graph here, is it a good time or not to get out? Well, the question is, what's your overage cost and what's your underage cost? So what's your cost if you get out, and what's your cost if you stay in? So let's assume that was the top of the market. You're reducing your exposure right now, and roughly 40% is sort of the average recession. Things go down 40% from top to bottom. So you'd be going down to around, call it, I don't know, 2,800 roughly around here. And sort of right before the run up on the pre-pandemic levels, that's roughly what you can expect. So just to put sort of just some rough numbers out there, that's what you would look at. You're looking at losing basically 1,900 points from the top of the market in the S&P 500. Yeah, and that's it. That was really the main thing I wanted to put out. Just sort of food for thought more than any sort of calls on the market. So right now we're roughly at 4,200, and let's say if you have the average recession, because we already had 2 quarters of negative growth, your typical drawdown would be around 40%. And I'm not saying that's what's going to happen. It could be more, it could be less, but that's roughly around 2,900. So there's still a lot of ways to go if we were to be in sort of that market sell-off recessionary type of environment. Any questions in the last couple minutes? Or parting thoughts? Yep.
Do you think we're in a housing recession already, a real estate recession?
That's a tough one. I think it really depends on the markets. What I've seen is inventory spike globally. But for example, us in Los Angeles, I was looking at those stats. I haven't seen Los Angeles really have, I've seen it getting worse, but I haven't really seen the inventory in Los Angeles really get high. It doesn't seem like it's still below sort of the pre-pandemic levels. Mm-hmm. So I think it's really local. But yes, I have seen it worsening on a global scale. Like the metrics, MBA, new MBA new mortgage applications has gone quite down. The inventories start going up. The number of days on the market have started going up nationally. But in LA, I haven't seen too much of an effect. I don't know how is it around this? I don't know, Dana Point or maybe Orange County.
Well, I live in a development that just got built, and the builder claims he's all sold out. I mean, it seems like it's still pretty popular. I mean, it hasn't slowed down at all.
So I used to own another property. I recently sold it a couple of weeks ago because I was worried just within hike in interest rates. I figured it was probably prudent to at least reduce the exposure. So that's me. But I still haven't seen any signs of the LA market cracking personally.
Okay.
The real estate agent that I talked to, he said, this time last year, you'd had, instead of having, the 10 offers you had last year on one house in the LA area, maybe you'll only get 2 or 3. That's sort of where he was coming out at. But that still doesn't seem like it's a weak market. It just seems like it's a less strong market at this point.
Did he say whether people are still overbidding like they were last year?
He said there was less of that. On the house I sold, there were seven offers, and people outbid it by 10% the list price. So I'm 10% above list price. But that was probably also part of the strategy. Generally speaking, if you list something lower, people tend to aggregate and get interest, and then you get a bidding war, which is much more beneficial than coming in too high and having to go down.
Mhm.
Anything else?
I'd like to ask, I hope it's not too open-ended a question for the end, but what would, well, you mentioned how Europe is really staring into the jaws of recession with the winter coming and the shortages of gas. And so that brought up my question, which is, what would happen if there start to become pockets of recession throughout the world before we go there? What impact would that have on supply side shortages and supply side induced inflation for us?
So the United States is, so contrary to Europe, which has a broader, I think, economic trade balance than we do, the United States is fairly self-contained in terms of its sort of supply demand. We do buy cheap goods from China, but generally speaking, the overall balance is not huge. So I think the US is a lot more isolated to the rest of the world going one way or the other versus the United States. So if you remember the GFC, the United States tanked and then Europe tanked. I think if Europe tanked, the United States wouldn't necessarily be dragged into it. But if the United States tanked, Europe would probably be dragged into it.
That's what
Does that answer your question or not?
Well, that seems to be what happened prior to World War II.
Yeah.
I had
The-
one last- oh.
Yeah, go ahead. Sorry.
On China, I know it's kind of, we don't really know what's going on over there because they kind of censor the media and such. And I know they're starting to stimulate their economy over there. I mean, what are your thoughts on China? Do you think they're already probably in a recession, or I know they still have positive economic growth, but
So maybe I can bring this up, but I think China's sold off. Let's see if I can find that. China's sold off quite a bit already. Should be in here somewhere. Can you guys see my screen or not? Oh no, you can't see my screen, right? New share. There we go. Can you see that? Yeah, there we go. Where is it? Europe, Japan, Australia. Where's China? Foreign rates, EM equity. Here we go. So if you, this is TradingView. This is actually accessible to a lot of people. It's free. I find it pretty interesting. This is China. The 50 largest companies in China, they're down about 34%. I think they've already had a pretty big correction, and it's been pretty protracted. So they peaked sort of around February 2021. They've had a zero COVID policy, which has not helped. If you recall, since the beginning of the year, they've been very locked down on it. I think they've got a big credit problem, especially in real estate. It seems like they're destroying things in real estate. I'll put this all with the caveat that I don't know. I'm not an expert at all of China nor near it, so I would put everything with that huge caveat. The thing that worries me the most, and I don't like investing in China because I feel like at any point the communist government can basically come and take your capital away without you having really much to say about it. They seem to be very prone on doing that. The biggest thing that worries me about China or investing in China is a similar type of Ukraine event. So China invades Taiwan, and then Russia, just like Russia, China becomes completely uninvestable. Anything that you had there just goes to zero, right? So if you want exposure to China, I would probably prefer something that has maybe like Australian or Korean, something that has some sort of exposure to them, but without sort of direct ownership of equities in China, because I'd be really worried of another sort of Ukraine-Russia event with Taiwan. And I don't know if you guys have been following the geopolitics, but recently China actually shot a missile over Taipei, not onto Taipei, but during their military exercises, they shot a missile that was whose trajectory went right over the capital. And they were doing military exercises within their territorial waters. So they've gotten a lot more aggressive in terms of their stance on the one country policy than they've been historically. does that answer your question? I don't know if you were asking about an economic standpoint or as an investable standpoint, to be fair.
No, just an economic standpoint, if they were gonna be like Europe, Europe's definitely gonna be in a terrible recession if they're not already, or do you think China is kind of bottomed, or I know they don't really share much with us, or do you think they're headed for a huge slowdown as well, a continual slowdown as well?
I think if the US slows down, it'll slow down the world economy, so they'll come with us.
Okay.
That's probably the biggest certainty I would have. I do think that they have much more of a command and control economy, so they manage this a lot more than we do in Western Europe.
Okay.
So absent of the US going off, I think they've probably stabilized for now, would be my guess. But I asked this question: how do you avoid China? Basically, if you invest in China, and you have to think about it as an investment thesis, how do you avoid the zero, your equity is worth nothing? There's really no way to do that. It's a very hard thing to do, even for people who are experts at China, from people I've asked. In terms of their economy pulling or dragging us down, I think they're probably neutral at this point, would be my guess.
Okay, that's what I wanted to know.
And again, you should not be, I just don't know enough about China for that to be an informed thought.
All right, thank you.